1 year ago, gold was trading at $2,300 an ounce. Today it is above $5,000. In January, it hit $5,600. That is not a rally. That is not a bubble. That is the sound of the global financial system voting with its feet. And if you think gold is just a shiny metal that retirees buy when they are nervous, you are not paying attention to what is actually happening. Because the institutions buying gold right now are not retirees. They are central banks. The People's Bank of China has been buying gold for 15 consecutive months. Not selling, not holding, buying every single month for over a year. And China is not alone. India, Poland, Turkey, Singapore, Czech Republic, and dozens of other central banks have been accumulating gold at a pace not seen in modern history. In 2023, central banks bought over 1,000 tons. In 2024, they did it again. In 2025, they did it again. 3 consecutive years of purchases exceeding 1,000 tons each year. Before 2022, the average was 400 to 500 tons. Something changed. And to understand what changed, you need to understand what gold actually is in the context of the global financial system. Because gold is not a commodity in the way that oil or wheat or copper are commodities. Oil gets burned. Wheat gets eaten. Copper gets wired into buildings. Gold sits in vaults. It does not generate yield. It does not pay dividends. It does not produce anything. And yet central banks, the institutions that literally create money, are buying it at a rate that has not been seen in 60 years. Why? The answer is one word: confidence. Or more precisely, the loss of it. When a central bank buys gold, it is not making an investment. It is making a statement. The statement is, we are not fully confident that the existing reserve currency system will preserve the value of our holdings. And the existing reserve currency system is built on one thing: the United States dollar. For 80 years, the dollar has been the foundation of the global monetary order. After Bretton Woods in 1944, the dollar became the anchor. Other currencies were pegged to it. International trade was settled in it. Central banks held it as their primary reserve asset. Oil was priced in it. This system gave the United States an extraordinary advantage, what economists call an exorbitant privilege. America could borrow in its own currency at low rates because the entire world needed dollars. It could run persistent deficits because foreign central banks were always willing to buy treasury securities. It could project power globally because the financial infrastructure of the world ran through American banks, American clearing systems, and American regulatory frameworks. That system is not collapsing, but it is eroding, and gold is how the erosion gets measured. Let me give you a number that captures the shift better than any headline. In the year 2000, the dollar's share of global foreign exchange reserves was approximately 71%. Today, it is roughly 58%. That decline, 13 percentage points over 26 years, does not sound dramatic. But in absolute terms, it represents trillions of dollars that central banks have moved out of dollar-denominated assets and into alternatives. Gold is the primary alternative. And the pace of the shift is accelerating. To understand why, you need to understand one specific moment. Because there is a before and after in this story. And the dividing line is a single weekend in February 2022. On that weekend, after the full-scale operation in Eastern Europe began, the United States, the European Union, and their allies made a decision that no one had ever made before at this scale. They froze approximately $300 billion in Russian central bank reserves. Not private assets, not oligarch yachts or London real estate, central bank reserves, the sovereign savings of a nation, accumulated over decades, held in what were supposed to be the safest assets on earth, US Treasuries, euro-denominated bonds, and deposits in Western financial institutions, frozen, overnight, without a court order, without a legal proceeding, by executive decision. Now, whether you believe that decision was justified is not the point. The point is what every other central bank on earth concluded when they watched it happen. The conclusion was simple. If you hold your reserves in dollars and you displease the country that controls the dollar, your reserves can be rendered inaccessible with a single executive order. Your savings, your nation's savings, are not fully yours. They are yours conditionally, and the condition is geopolitical alignment with Washington. For countries like China, India, Saudi Arabia, Brazil, and Turkey, countries that maintain complex and sometimes adversarial relationships with the United States, that precedent was not just a warning. It was a restructuring event. The rules of the game changed on that weekend, and the response was immediate. Central bank gold purchases surged from roughly 500 tons per year to over 1,000. China began reducing its treasury holdings from over $1 trillion at the peak to approximately $730 billion today, the lowest level since 2008. And gold, which cannot be frozen, which cannot be sanctioned, which exists in physical form inside sovereign vaults, became the asset of last resort. Not because it generates returns, but because it cannot be confiscated. That is the shift. The world is not abandoning the dollar. It is hedging against the dollar. And the hedge is priced at $5,000 an ounce. Now let me show you why the price move is so extreme, because the scale of what has happened in the last 12 months is genuinely historic. 1 year ago, February 2025, gold was at approximately $2,300. By October 2025, it crossed $4,000 for the first time. By late January 2026, it hit $5,600. Then it crashed nearly 9% in a single day, falling to around $5,000, after the Chicago Mercantile Exchange raised margin requirements and forced leveraged traders to liquidate. Silver fell 26%. It was a liquidation event, not a fundamental change, and the price recovered within days. Goldman Sachs has raised its year-end 2026 forecast to $5,400 per ounce. JP Morgan projects gold averaging $5,000 per quarter through the year, with $6,000 as a longer-term target. Central bank purchases are expected to average 585 tons per quarter, more than the entire annual total of 10 years ago. And ETF inflows, which represent retail and institutional investor demand, are projected at 250 tons for the year. The demand is broad, it is structural, and it is not going away. Now here's the part that connects this to your daily life. Because gold at $5,000 matters, even if you have never bought an ounce of it. The price of gold is an inverse confidence indicator for the global monetary system. When gold rises, it means the market, including the most sophisticated institutions on the planet, believes that the value of paper currencies is declining. And when paper currencies decline in value, everything priced in those currencies gets more expensive. This is one of the mechanisms through which inflation persists. Central banks print money. The money loses purchasing power. People and institutions buy hard assets, gold, real estate, commodities, to preserve value. The prices of those hard assets rise, and the rise in asset prices feeds back into broader price levels, because the people who sell gold buy goods and services, and the people who build real estate use materials that have also risen in price. It is a feedback loop. And gold at 5,000 is telling you that this loop is accelerating. The Federal Reserve wants to cut interest rates, but persistent inflation, partly driven by fiscal deficits, partly by tariff-induced price pressures, and partly by the hard asset cycle, makes it difficult to cut without reigniting the very inflation they are trying to control. The federal deficit is nearly 6% of GDP. Interest payments on the national debt exceeded $970 billion last year. Every dollar of deficit spending adds demand to the economy. Every dollar of demand sustains prices. Every sustained price level keeps the Fed from cutting. And every month the Fed does not cut, the economy stays under pressure, which drives uncertainty, which drives more gold buying. The spiral feeds itself. Now let me show you the silver side of this, because what happened to silver is even more dramatic. 12 months ago, silver was around $30 per ounce. Today it is around 80 to 85. In January, it hit 117. That is a 300% increase in 1 year. 300%. Silver has always been more volatile than gold. It has both precious metal demand and industrial demand. It is used in solar panels, electronics, medical devices, and increasingly in electric vehicle components. The combination of investment demand and industrial demand has created a supply squeeze. And when the CME raised margin requirements in late January, silver fell harder than gold, dropping 26% in days. But the rebound was equally sharp, and the fundamentals have not changed. Bank of America has set a price target of $170 per ounce. Citi upgraded its short-term forecast to $150. If these targets are even approximately correct, silver still has significant room to move from current levels. But here is the deeper question, the one that matters more than any price forecast. What does it mean when the most ancient store of value on Earth, a metal that has been used as money for 5,000 years, outperforms every major stock index, every bond market, and every cryptocurrency over a 12-month period? It means the market is scared, not panicked. Scared. There is a difference. Panic is short. It spikes and resolves. Fear is structural. It builds over months and years. It changes behavior at the institutional level. It reallocates trillions of dollars. And that is what is happening right now. Gold's share of total global financial assets has risen to approximately 2.8%, up from under 2% just 3 years ago. That does not sound like much. But in a world where total financial assets exceed $400 trillion, even a 1% shift represents $4 trillion of capital moving into a market that is much smaller than the equity or bond markets. That volume of capital entering a constrained market is what produces the price explosions we are seeing, and the capital is still flowing in. So what should you watch? First, central bank purchases. If quarterly buying stays above 500 tons, which JP Morgan expects, the floor under gold prices remains firm. Any drop in price will be met by institutional buying. Second, the dollar index. Gold moves inversely to dollar strength. If the dollar weakens because of rate cuts, fiscal uncertainty, or loss of reserve currency market share, gold rises. Third, real interest rates. Gold's primary competition is yield. When real rates, interest rates minus inflation, are high, gold looks less attractive because bonds pay you to wait. When real rates are low or negative, gold becomes the default preservation asset. Right now, real rates are hovering near zero. If they turn negative, which several forecasters expect in the second half of 2026, gold could accelerate again. Fourth, geopolitical escalation. The Iran situation, the tariff regime, the Hormuz closure precedent, the ongoing tensions in Eastern Europe, each of these adds a risk premium to gold. If any one of them escalates into a broader disruption, gold does not just rise. It gaps up, meaning it jumps past intermediate price levels overnight without giving anyone a chance to buy at the old price. That is what happened in January when it went from 4,700 to 5,600 in less than 3 weeks. Fifth, the Fed. If the Federal Reserve begins cutting rates, which markets currently price is likely in the second half of 2026, the opportunity cost of holding gold drops, and that removes the last remaining headwind for prices. Rate cuts plus geopolitical risk plus central bank demand plus fiscal deficits plus declining dollar share, that is not one reason for gold to rise. That is 5 simultaneous reasons. And they are all active at the same time. That has not happened since the 1970s. And in the 1970s, gold went from $35 to $850 in a decade. A 24-fold increase. We are currently at roughly a 2-fold increase in 12 months. If the structural forces remain, and there is no sign they are reversing, the comparison to the 70s is not hyperbole. It is a framework. Let me put this in the simplest possible terms. 1 year ago, gold was $2,300. Today it is $5,000. Goldman says $5,400 by December. JP Morgan says $6,000 is possible. Central banks are buying at a pace not seen in 60 years. The dollar's reserve share is declining, and the metal that has been used as money since before the pyramids were built is telling the world something that no central banker will say publicly. The system is under stress, and the people who run it are hedging their own positions. When the people who create the money start buying the one asset that exists outside the money, pay attention. That is the signal, and the signal is at $5,000 an ounce. If you want to understand how these forces shape your money, your purchasing power, and the global economy, make sure you are following this channel, because this story is not about gold. It is about confidence. And confidence, once lost, does not come back at the old price.